There are different facets of risk that go into each investment. We're going to talk about them, but most importantly, not all risks are created equally. Even if two investments have the same standard deviation, they may have two completely different expected return profiles. So, what you're seeing here is effectively the outcome of this idea that more risk does not mean more return, but we can even go further and say that equivalent risk or measured equivalent risk does not necessarily imply same expected returns. All right. So here you assume significantly less risk taking on Microsoft in your portfolio and you generate more return. Just because you assumed more risk in this AI startup, it does not mean that you are going to achieve a greater return, especially in the long run. All right. Now, what is the math to support that it's better to optimize your risk adjusted return relative to just absolute return? Well, that's this idea of volatility drag. Effectively, what we're saying here is we don't just want to subject ourselves to the highest potential return because we're going to be assuming way more risk and we might lose all our money. We actually want to consider a risk adjusted return, meaning we're getting a fair return relative to the amount of risk that we're taking, like we see on the right here with Microsoft. We can prove that this actually optimizes our portfolio value in the long run using this concept of volatility drag. So math effectively proves unnecessary big swings are more dangerous and devastating to the compound growth of your portfolio in the long run. And there's a literal equation here that shows it. And I've plenty of videos on this channel talking about volatility drag, proving it, and also talking about slaying the volatility dragon. This is exactly that idea. On the left, what you're observing is the slow growth of convexity. You don't get something for nothing. We're paying for it with time. You can see that we're accumulating this growth over a very many number of years. Versus on the right, you're chasing high returns with a very high volatility profile, and you actually end up losing a significant amount of money over 10 years relative to just proper investing on the left. This isn't by accident. This is because of volatility drag. You can see here that due to the way that returns are compounding over time, we actually receive a volatility penalty. And this is what I show in my video deriving this notion of volatility drag. Effectively, the more volatile, the more choppy your return path is, the more you lose in terms of compounding your geometric wealth, the mean of your geometric wealth paths, if you will. If you're targeting a role as a trader, market maker, quant, or you're just looking to grow and protect your portfolio in all market climates by applying quantitative strategy, Quant Guild has two crazy free resources available to you. When you get started, you can pick your track. You can always change this later. If you're looking to break in, head on over to the Quant Roadmap. Every topic in the right order that you need to know for success in different roles. You can select them here. It will tell you the exact breadth and depth of knowledge you need in each for success in interviews and the career as a whole. And of course, if you're looking to grow and preserve your wealth, you're going to want to run your own personal hedge fund. This isn't a day trading strategy. It's structure institutions use every single day to cut their downside risk in half, improving their overall long run return. I have a free quant research note available to you on this page for exactly what is going on. Link in the description below to Quant Guild if you're interested in these free resources.